We're continuing to see plenty of volatility in stock markets, and nowhere is this more clear than in the Nasdaq. The tech sector has been incredibly sensitive to changes in interest rate expectations, and that's been obviously one of the key talking points so far over the course of this year. Inflation rising much faster than many anticipated, much higher than many forecast, including many of these central banks, and therefore we are seeing much more hawkish commentary from central banks and much higher interest rate expectations across the board here over the course of 2022. And as we've seen already, and as we've talked about before, the tech sector is particularly sensitive to that. Now, that could be for a number of different reasons. Some of these are massive growth names that are reliant on debt loads and where interest rates have been, or low interest rates have been very supportive for that, and where investors have been extremely forgiving for low or no profits over a long period of time because of the rapid state of growth within many of these firms. And therefore, these higher interest rates have become a major headwind as far as many of these names are concerned, because so much has been priced in up until that point. Also, in this kind of post-pandemic period, now we have seen a number of these names come under strain because of the supercharged growth we saw over the course of the last 2 years, and many of these names not really being able to carry that through into the post-pandemic period. So I think there's been a number of different headwinds as far as a number of these tech names are concerned, and that's really come to the fore over the course of this year. We saw much sharper declines in the Nasdaq over the opening months of the year, as interest rate expectations were being ramped up significantly. And we're continuing to see some weakness there as well, more so than in other areas of the market. And we saw the Nasdaq have a difficult start to the week, or a difficult middle part of the week, following the release of the Netflix results. Now, we are very much in the midst of earnings season now, so there's going to be a lot more focus on these big tech names as a result. And Netflix really disappointed the market and really shone a spotlight now on not just the streaming services area of the market, but other areas of the market as well, which are which have a massive consumer element and which are therefore vulnerable to this higher cost of living crisis that we are currently seeing around the world. We saw that Netflix lost 200,000 subscribers in the first 3 months of the year, and it expects to lose 2 million more over the course of the next 3 months to the middle of the year. That's a massive number, and that came as a massive shock to the markets. We saw the Netflix stock itself drop around 30% in trading yesterday, and it really did drag down the wider tech sector with it. And that's a massive concern, because now investors have got to be asking themselves, which of these stocks performed really well in the last 2 years that don't necessarily have the growth potential that had previously been factored in, but also now which stocks are really sensitive to the cost of living crisis, and which companies now are vulnerable to the cutbacks which households are inevitably going to have to make, whether consumers are already feeling the cost of the higher cost of living crisis and therefore making forced cutbacks, or making premeditated cutbacks. But which areas are now vulnerable to that? Obviously, things like consumer spending in stores is going to be one area of interest now going over the course of the rest of the earnings season, and whether companies are going to be warning about this. But streaming services is an obvious one because of how easy it is to obviously cancel the subscriptions, how many people within households can share these subscriptions, which is something that Netflix is going to look to address, and also how many subscriptions were built up over the course of the last year, where consumers are now saying that they don't necessarily need them. And that's one of the reasons why I think Netflix was hit so hard. But now other companies and other investors are going to be looking at other companies and other sectors to see where the vulnerabilities lie along the same lines for them. So the tech sector took a hit yesterday, massively underperforming the market, which was broadly quite stable. In fact, the Dow and the S&P actually performed relatively well. That came until Tesla reported earnings last night, which positively surprised investors, which is giving the tech sector a bit of a bump today. But again, this is going to be a very interesting earnings season, which has got off to a strong start. There are going to be some good results and some bad results, but the interesting thing is going to continue to be whether many of these firms have a viable business model and can continue to perform well in this high interest rate environment. Tesla is one that many think will continue to perform well, but there's going to be other areas where there's going to be key vulnerabilities. And Tesla showed its strong performance yesterday, but others may not be so fortunate. And in terms of what this means for the broader index, I've got a chart for you on the screen now. Now, this is a split chart. You've got the daily chart and you've also got the 4-hour chart next to it. The reason why I've put these two charts next to each other is because they are both alluding to effectively the same thing, obviously, but also broken down onto a shorter time scale. The left side of the chart is the daily chart, and you can see this inverse head and shoulders forming here. And I think this is going to be a really interesting one to follow, because the neckline of the head and shoulders falls around 15.2, 15.3. And we saw that run into resistance there in the early stages of February, and then again in the late stages of March and early April as well. So that's formed that kind of neckline for the inverse head and shoulders. The shoulders then form around 13,750, again, an area that we saw in the middle of January, and then again in the middle of April. Then, of course, the head therefore forms around 13,000, and we saw that in the middle of March and also in late February also. Now, those levels are going to be key for me. If we see a break above that neckline, that could suggest that we've seen a lot more bullish momentum forming. That would also take us back above the 200, 233-day simple moving average band. So I think that's going to be a really interesting level to watch as far as the Nasdaq is concerned. A move below those shoulders there around 13.7 I think could also be a strong signal as well. So two levels to watch there on the daily chart. If we break this down to the 4-hour chart, you've also got a shorter term inverse head and shoulders forming there as well. This is formed now over the course of the last couple of weeks. Again, in this case, you've got the neckline around 14.3, and you've got the shoulder around 13.9, 14,000. So I think that could potentially be a shorter term signal if we do see a break above the neckline of that inverse head and shoulders, if that is obviously completed. And obviously the good thing about these inverse head and shoulders, like obviously head and shoulders, is they give you potential price projections levels as well. So this could be a really interesting signal to watch out for. A break through that neckline could potentially be a signal of a move back towards that kind of 61.8 fib. 50 to 61.8 fib on a conservative basis, maybe more broadly if you're taking the head to the neckline as well. And that could potentially therefore signal a move back towards the neckline of the inverse head and shoulders on the daily chart, which is why I've got these two charts next to each other, because flicking back and forth between them would have been very difficult. But you can see that because of the size of the formation on the 4-hour chart, a more bullish breakout here beyond the conservative potential price projection using the head to the neckline takes us back somewhere towards the region of the neckline of the inverse head and shoulders on the daily chart. So there's some really interesting levels to keep an eye out for on the Nasdaq. This could be a challenging earnings season, and especially if we continue to see intraday expectations ramped up, that is going to exert or could potentially exert downward pressure on the tech sector and therefore on the Nasdaq. But it's going to be a really interesting one to watch here over the course of the next couple of weeks, and I think we could see some potentially strong signals forming on the back of that.